Hey, what's up, investors? Today, I want to talk about the great debate, stocks versus real estate. This is one of the most frequently asked questions. In fact, it was a question that I asked when I first started my real estate investing journey about 3 years ago. I started off with only $500 and I was trying to figure out where to start. Now, I want to show you what I went through to figure this out and then tell you what probably is the best route for you. Should you invest in stocks or should you invest in real estate? So let's go ahead and find out. So first off, we're gonna have to define exactly what we mean by stocks and real estate, because if we're talking about real estate, then we could be talking about wholesaling, we could be talking about flipping, short-term rentals, large apartment complexes. I mean, the list goes on, storage and all kinds of stuff. And even in stocks, there's actually quite a bit of options on this, all right? So we have short selling and options and futures trading, and then you could do day trading rather than like long-term investing. So for the purpose of this video, we're going to make this very simple, down to the stocks and real estate that most of you are probably thinking about. And that is long-term residential rentals, so little tiny houses, for a family, just for you to rent out normally, and then stocks being the S&P 500 index fund. That's one I didn't mention, but a lot of beginners usually start with an index fund since it's essentially you branching out your investment across dozens, or in this case, hundreds of different stocks. These two types of investments are often seen as the safest ones for new investors. So we're going to talk about that. And remember, stocks, for those of you out there, it's not gambling. Many people think it's like gambling, but stocks, actually, there's a lot of strategy to it. You actually have a lot of market research behind it as far as analyzing the companies and the CEOs and the market strategies and the future of that industry. There's a lot of stuff you can read up on it. So it's not exactly gambling at all. And but for the index fund portion of it, we're really not managing this. We don't need to look into a specific company. We can look into lots of different companies. So these two are the most accessible to new investors. So let's break it down, all the numbers, okay? We're going to talk about everything regarding them, figure out what's best for you. So the first one is getting into this sort of investment. So by and large, real estate is probably going to be the harder one to actually get into, because although you can buy a piece of real estate, you have to qualify, and not only qualify, but many of you are going to use other people's money or leverage. This actually, in a sense, makes it easier to get into lots of real estate. Okay, so for those of you who don't know, I own 8 houses, but I didn't pay all cash for all 8 houses. I mean, I have over now $2 million in real estate, but I didn't pay $2 million for it. So that is one of the advantages of real estate, is that you can use leverage in order to buy it. But it's still difficult. There's a lot of qualifiers to get in. Whereas stocks, you just set up a brokerage account and then just buy it. You click and buy. So with this one, the ease to get into it is technically going to go to both. Stocks, you're limited to the amount of money that you're going to put in. So let's say you're starting off with 100 grand. I know probably more than what you have, but for a lot of these examples, we're just going to use 100 grand. Much easier to just pie in, but your 100 grand will take you a lot further in real estate with leverage. If you do not intend to leverage and you're just going to buy a $100,000 house all cash, then you might as well stick to stocks, because then it won't make any sense for you to stay in real estate. And if that's got you questioning things, well then keep on watching, because I will absolutely explain why. Now, there's 2 main ways that these assets can make you money, and that is with cash flow and appreciation. However, there are a couple other more ways that we will discuss with real estate, but that's the 2 main ways that most investors are trying to achieve. Now, when we're regarding stocks, on average, you can't really make any cash flow from a stock. You really just wait for it to go up in value and then you sell it. However, there are dividend-paying stocks, and for the S&P 500, it actually can pay a dividend in certain forms. So we can analyze that. Generally, a dividend off of your average dividend is going to be 2.5% for the yield that it's going to keep paying you monthly or quarterly or yearly, however it pays you. However, when we analyze these returns, keep in mind we're almost always talking about yearly, and in the case of this video, it will always be talking about yearly. And there are some stocks that will actually pay you as high as 3 and 4%. Those are actually considered pretty high dividend paying stocks. And so that's probably about the best you're going to do in that world when it comes to cash flow. Now with real estate, on the other hand, it is much more of a cash flow producer. Obviously, you are buying real estate with the intent to rent it, not just sit on an empty house. So with that, generally you're looking at often 10% returns on average in the real estate world. That is the number you want to achieve. But to be honest, many people achieve much higher than that. And so in this case, 10%, if we take our $100,000 example, it's going to be $10,000 over the course of the year, or $833 a month, about that. And essentially, obviously, real estate is the king of cash flow. So if you're looking for cash flow every single month in order to quit your job, let's say, and replace it with real estate income, you're probably going to find this a ton easier to do with real estate. So here, real estate is the winner. Now, with appreciation, that is the value of your property or your stock going up in value. Obviously, when you buy a normal individual stock, this can fluctuate quite wildly depending on the company, but the S&P 500 often gets a 10% appreciation, or 7% if adjusted for inflation. Inflation's about 2 to 3% a year, so about 7%. Keep in mind, this is the average, okay? The last year alone, we had 13% appreciation across the S&P 500 in year 2020. So you're going to see more than that some years. You're going to see less than that some years. And if you invest in individual stocks, you're going to see as high as 28% generally on most companies, and some as high as 88%. Like if we talk about Apple, it made 88% last year. So it is a lot higher than your average returns when it comes to real estate, which I'm going to talk about now. So your average real estate deal is only going to appreciate probably 3 to 5% a year. That is the average across the home market. And honestly, if you're talking about Baltimore, the city that I invest in, well, the average appreciation rate across most of the houses, not including some of the nicer areas, is like 1%. So you are being crushed there on the appreciation level by stocks. So if you're trying to make your money grow in value, then stocks is going to be the winner when it comes for an appreciation play. Now let's talk about risk, because it's not all about the amount of money you're raking in, because a lot of you are going to be real worried about what are the risks you're taking on, what is the likelihood you can fail. Well, stocks tend to fluctuate a lot faster in value than real estate does. So this is something you definitely have to keep into account, is that your money is going to go up and down. And what this can do is create emotional reactions in you that are going to make you want to get out of the stock or something like that, which you shouldn't. Whereas real estate, I mean, honestly, even in a real estate market crash, the effects are a lot slower. Even a foreclosure, a massive foreclosure wave, is going to take a year just to really take effect. So this is something in favor of real estate. However, we have to really remember one thing that is working in stock's favor, and that is you can only really lose the money you put in. With real estate, well, except for with short selling, but obviously we're talking about normal stocks and index funds here, but with real estate, essentially, you can lose much, much more than you put in, and it's much harder to get out of it. So with stocks, if you're losing a lot of money, you can just sell the stock, no big deal. But with real estate, not only it's harder to sell a home, it takes a lot longer, but you will always have to pay the property taxes, always have to pay the insurance, the utilities, the maintenance, and if you have a mortgage, which you should, like I said, in this case. So since it's so much more difficult to get out of, and it can penalize you and make you lose far more money than what you put into it, you always have to understand that real estate is far more risky than stocks. So if you're really, really risk adverse, then maybe real estate's not for you. Now, as far as performance is concerned, we're going to break the numbers down on exactly how performance works, but just understand that it's much easier to buy into a good real estate deal than a good stock. See, the thing is, real estate operates on an imperfect market, which means essentially that it's kind of estimating the level of information that everybody has. When you're working with stocks, everyone is working off relatively the same amount of information, which makes it a much more perfect market than real estate is. But with real estate, the unique locations, the seller, because the seller can maybe not know what they're doing. A lot of people don't know what repair costs and renovations are. A lot of people may not have access to the resources in order to repair it cheaper than other people. And a lot of people are more creative with the strategies that they can use that I talk about on my channel all the time. So essentially, you're looking at real estate. It's much easier to kind of find that really good deal rather than stocks, where it's like, it can gotta really be hit or miss. And especially if all you're doing is the S&P 500, then you're never really gonna find a great deal. You're just looking for consistent returns over time. Real estate, you can get much more than that. So if we're talking about performance metrics and maybe maximizing your performance, real estate's going to win there. Plus, we haven't even talked about forced appreciation. I alluded to it with contractors. You can force your property to become more valuable, whereas a stock, you have no control. Real estate, you can physically touch it and feel it and know exactly how to make this property better. So in performance standards, if you are willing to take the risks that we have mentioned before, then you will find much more value in real estate that you can control. Now we're going to have to talk about taxes, because with taxes, stocks take a huge hit here. So Uncle Sam wants his cut of your taxes, of all the money that you're making, and essentially you're going to pay 20% capital gains on stocks, sometimes as low as 15% if you are holding it for a much longer term. Real estate is effectively the same. However, there's so many deductions in real estate that you're often going to find you're not paying any taxes at all. This is a situation that I wound up in where I made over $100,000 in revenue, okay, so not necessarily profit, but revenue, but I paid zero in taxes across all of it. In fact, I paid so little in taxes that it started affecting my W-2 income, and I paid less taxes there. So even though I was making essentially $250,000 in revenue, I paid taxes on only as if I made like $80,000 and possibly less in some cases. So, I mean, there's so many deductions, and we're going to break that down when we talk about our, which one is better later on in this video, by the numbers, stocks or real estate. Well, you're going to have to factor in those taxes, and real estate wins hands down here. There's not very much. There's a few things you can do, but not very much you can do to lower your tax obligation for stocks. And the last one we're going to have to talk about before we break it down by the numbers is the work involved. Obviously, real estate takes a lot more work. Stocks, you click a mouse and you're done. You don't even have to look at it again. You can ignore it. Even if you hire a property manager for real estate, you still have to manage the property manager. You still have to know what's going on with your property. Also, it's going to hold you to a location and all of that. So now if you're further away, this becomes harder to manage than if you were closer to your properties. So this becomes a little bit more difficult to work with. Also, I mean, as far as the human factor, you're going to have to factor in the personalities of the people you're going to be dealing with. The tenants may destroy your property. Obviously, a company, yes, could suddenly do something really dumb and, lose their company and you lose all your stock with it. But if you just invest in the S&P 500, then you really have no risk of doing that, since your risk is applied through multiple different companies. Well, unless you're in some sort of real estate investment trust, like a REIT or something, you can't do that with real estate. So just keep that in mind, that obviously the work is much more expansive, and if you're not willing to do the work, well, stocks are going to be for you. They're the obvious winner in this category. All right, so here we go. Which one is best for you, and why did I pick the one that I picked, and what I recommend for you going forward, okay? So let's go ahead into the S&P 500. Let's say you have $100,000 and you're trying to shove this into this game. Well, with $100,000 in the S&P 500 index fund held for 5 years at 10% returns, which we mentioned is the average appreciation rate, you're going to be looking at getting $146,000 at the end of those 5 years. But of course, we're going to have to factor in taxes. So taxes are for $40,000 to $441,000 is going to be 15% if you hold it long term, which we're talking about for this video. You're holding it for 5 years. Anything before 1 year is going to be short-term capital gains. So in the long term, you're going to be paying on that $46,000 and $410 in profit. You're going to be paying $6,961. And essentially, it's going to earn you $39,448.50 across that. Now, keep in mind, this is without adding anything. You did not add any more to the S&P 500. You did not do anything regarding that. And also, you keep in mind, you could also reinvest your dividends if you happen to be in the version that actually does that, which will earn you a slight bit more. So, but that's essentially the numbers you're looking at. Now, if we factor that across your time invested, well, you click the mouse a few times, so you're pretty much making all that in a single hour. If we are talking about wages paid per hour in this case. Obviously, in real estate, it's going to be a lot worse than that. So let's go into real estate. What are we looking at? $100,000 in real estate? Okay, so the problem with paying all cash real estate. Many of you are probably wondering here. So before we get into real estate numbers, when we talk about the leverage side of it, the problem with paying all cash is your returns suck. Okay, think about it. If you get the average 1% rule in real estate, that means 1% of the value of the house you're making in revenue. So 1% of $100,000 is $1,000. So you're making $1,000 a month, but you own the house all cash. Well, what is the returns on that? How long will it take for you to make your money back? It will take over 10 years because you're getting a 1% return. That makes 0 sense. Just put it in the S&P 500. We've just seen how that works, and now you're dealing with less headache, less problems, and all of that. So, just put it in the stock market and you're good to go. You don't even have to worry about it anymore. All right. But for those of you who know to use leverage or even the BRRRR strategy, and we're not going to discuss the BRRRR strategy, but if you don't know, that's how I get my houses for free. Okay. So look at my other videos on that to look at what the BRRRR strategy is. All right. We're going to be investing a 20% down payment on 5 different houses. So each house is going to be $100,000. We're going to take our $100,000 that we have and we're going to strew it across 20% down on all the houses. That will leave us with 5 houses. All right. So with that, we're going to be the principal and interest on a $80,000 loan. Okay. Remember, we put 20% down is going to be $381.93. Now, of course, you have insurance. We're going to factor in $100 a month for that. For a little house like this, that sounds about average. And then taxes, we're going to say it's 1% of the value of the house. So, different tax rates are going to be different across the country, but that's a pretty good average. And so that's going to be another $1,000 a month, which is going to be $83.33, which means your total mortgage is going to be $565.26. Now, keep in mind, that's just on one of the 5 houses, so you would have to multiply that by 5 in order to know all of the mortgages. But let's say you're following the 1% rule, and that gives you $1,000 in cash flow a month. All right, this is going to net you essentially $434 once you minus that $1,000 by your mortgage amount. All right, so what does that mean? Okay, so let's factor in maintenance. All right, you're taking $100 off for maintenance, so that leaves you $334.74 per house per month, which essentially, for all 5 houses, is going to actually net you $1,673.70 in a month, which comes out to about $20,084 a year. So you can see already that you're actually making more with these 5 houses than you're actually making with the stock market already, even just on the very bare basics here. All right. So over the course of 5 years, you're going to be earning $100,422. And there you go. So match that up against the $39,000 that I mentioned for stocks, and you are way outperforming here. And remember, you also have more houses, so you're getting principal pay down, you're getting depreciation, you're getting tax advantages. So let me explain all that real quick. There's 4 ways that actually houses make money versus stocks. Okay, houses make money in principal pay down. Your tenants are paying that mortgage every single month. You also make money in tax advantages, so you're going to be paying less in taxes, which I'm about to get into. You also make money in cash flow, and you also make money on that appreciation. And I didn't factor appreciation into this, but remember, each of your houses is rising at a rate of 3 to 5% every single year. So you're making money on the equity, both on principal pay down coming down and your appreciation going up. So essentially, you're making a lot more money in real estate, and that makes sense because of the amount of time that you're putting into this. All right, the industry has that drawback, right? And every other drawback we've mentioned. Now let's talk about taxes for a moment. Okay, technically you should be paying 20% on your taxes, but like I said, I don't pay for my taxes on my real estate income. Why is that? Well, you have travel expenses that you conduct. Don't have that on stocks. You have home office deductions. You have depreciation. You have maintenance, utilities. You're paying interest on the property. And if you do any renovations, well, then that too is also deducted. I've spent $100,000 on renovations in 1 month, and now all of that is tax deductible. Now, for those of you who say, oh, well, now you spent an extra $100,000, so that shouldn't count. No, it does, because using the BRRRR strategy, you're not actually going to be paying for that personally. So once again, watch previous videos if you don't know what I mean by that, all right? Plus, then over the course of 5 years, you're going to have rent increases. You're going to have just all the other stuff that's combined with it. So real estate is going to way outperform stocks. So what is it that you should do? So as far as performance and all that, sure, we could say that you should do real estate, but to be honest, it is actually better to do both. All right, I have a lot of money invested in stocks as well as crypto, and eventually I'll be doing private lending myself. Okay, there are a lot of other investment strategies. Why are they there? Well, it's because let's just say you have tons of money. It's so much easier to just move that money into an index fund than it is to find a good deal. To find a good deal in real estate is a bit difficult, and at a certain point, you're going to notice these millionaires don't even bother with it unless the property is heavy in value, because we have millions and millions of dollars. Having it sit around waiting for real estate deals may not be the best strategy. Sometimes it's better to invest that in the stock market where you can make those returns more guaranteed and you don't have to worry about all the work involved with real estate investing. Now, some people in some YouTube channels do automate this process a lot more, but if you're not that person, then you may have to consider, okay, you have a lot of money, you may want to go the stock route. Now, I didn't have any money. I only had $500 when I first started this, so I could use the principles of leverage to buy real estate. And then once my real estate starts making money, now I have almost $100,000 now thrown into an S&P 500 and such. And I have more in crypto, which we'll talk about in this channel and such. So keep that in mind, that it is not as clear cut as one is better than the other, all right? So just note that. Let me know down in the comments below which one you're choosing to invest in. And also, we will be talking more about stocks on this channel over time. I actually do want to cover all forms of investing, including private lending, crypto, and all that. So let me know what you think of this video. Hopefully I answered your questions, and I will talk to you all very soon.